Okay, in this video we're going to talk about managing a portfolio. So we'll talk about process-wise, what strategies can you use, how can you develop a portfolio itself. But then in the end we're also going to talk a little bit about performance and how you measure whether or not your portfolio, the thing that you've created, is it doing what you expected it or wanted it to do. So we need to develop a plan for allocating assets, and that's really the key here. Is it's referred to as asset allocation. So how do you disperse your investment dollars, not necessarily across individual securities, but across individual investment classes, if you will. In its simplest form, we would say, how much money do you want to put in bonds and how much money do you want to put in stocks? What is that proportion? That is what's referred to as asset allocation. Now, the things that drive your choices are these characteristics here, right? They're level and stability of your income, your age, investment experience, tax considerations, right? But there's also some other objectives, right? I mean, those are individual characteristics those of your person, but we also have to understand that different objectives, different investments have different objectives. If you're saving money to buy a house, that's different than if you're saving money for retirement. So we need to understand what those objectives might be. Is it income oriented or is it capital appreciation oriented? So if you think about these objectives, right? Current income or capital preservation, right? We need low risk kinds of investments. We're typically going to be looking for low beta types of securities. Capital growth. Obviously there we're looking for higher risk types of investments, higher betas, if you will. If you're interested in reducing taxes, we may be looking at certain types of bond instruments, right? Certain types of strategies within equities. And again, if you just want to manage risk, right? I mean, that's obviously one of our objectives, is to understand and manage the amount of risk that I'm taking. Those are all objectives and or policies that we may want to consider. So again, asset allocation is the process of dividing across asset classes. Now, the idea here, it's based on the belief that the total of the return of a portfolio is influenced more by this than by actual investments in each asset class. So again, there have been studies shown that about 90% of a portfolio's return can be attributed to asset allocation. So what does that mean? It really means that there's two steps to the process. You need to determine what percentage of each asset class you want to invest in. Once you've decided that, hey, I'm going to put 40% of my money in stocks, then you have to decide what stocks go in that 40%. So asset allocation is the mega classes, if you will, and security selection is within those classes. So we have to develop this scheme before we think of investing in individual securities. And again, as we mentioned, there have been studies done that shows that this is a very effective way to make sure that you have the highest rate of return that you possibly can. Putting activity towards this choice can be very valuable for the investor. So how can we set these percentages, right? How can we set these goals? And again, we can do it with fixed weightings, right? It's a fixed percentage. We could have a flexible approach, depending on market analysis, etc. We could have these weights, plus or minus 10%. Or we could have some type of a tactical approach where, because of some concept we have about markets and how markets are working, we could use index futures and bond futures to help change the portfolio allocation to move returns up when we think that changing the portfolio mix would be helpful. So actually using these index futures can be very helpful, and we will have videos later on that talk about these types of assets that are useful in this risk analysis variation, if you will, of trying to maximize returns. So what asset allocation involves, again, is just a mixture. So a very conservative, low return, low risk investment will have very little in stocks, 15%. They might have 35% in short-term securities. Very little in foreign securities, because we're really worried about risk. And if you switch clear to the other end, you can see that all those numbers change. And if you work with investment professionals, they can help develop a weighting system that matches your needs so that you can invest properly, giving your risk tolerance and your risk objectives. So how do we ultimately apply this, right? We have to look at economic outlook, right? We have to look at savings and spending patterns, tax situations, right? We need to understand the returns that come from different asset classes. We need to have some periodic review, right? This is going to require us to do a little bit more often than normal, maybe. We need to consider using mutual funds, especially if you have portfolios under $100,000. And we have to look to the long term, right? 7 to 10 years. So the key to any of this success, and quite frankly, I think the key to investing in general, is to have a plan and stick with your plan. Don't go off the rails with little deviations in what you think is happening. That is, don't let the marketplace dictate changes when maybe those the things that you're seeing in the news, maybe they are temporary. So we want to let things ride if we can. And asset allocation is one of those things that can help us. We have to look for progress, right? We have to talk about performance. And that's what we're going to continue to talk about throughout most of the rest of this video, right? How do you determine whether or not your performance is what you're looking for? And the idea in general is to look towards some type of a benchmark. And typically, especially when you're looking at equities, we're going to look at some broad-based equity index like the S&P 500. But if we have a bond portfolio, maybe we want to look at a bond index. Or if they're mutual funds, maybe there are some Lipper indexes that we can look at that look at the returns in general of a very broad set of assets. And from previous videos, I know we've talked about this thing called the holding period return. It's just your capital gains or loss plus any income divided by beginning value. So that is the essence, right? What has this portfolio done for you? Now, we also want to look at this on an adjusted basis, right? If this has been a 5 or a 10-year investment, we want to adjust it for time. So if you're measuring performance of investments, the holding period return for common stock and preferred stocks, obviously we have to include cash, right? Dividends. For bonds, we're going to include interest income. For mutual funds, there's a return of the investment, our dividend income, right, and the change in value. So we need to look at, with mutual funds, as we've mentioned in a previous video, there's 3 ways you make money. So any way you can make money has to be incorporated into this formulation of investing. So here's a quick little pre-tax holding period return, right? So we purchased for 27,312. We sold it for 32,040, and we received 2,000 in dividends. And of course, when you calculate this return, essentially we've earned 24.63%. But this is a 1-year return. Remember, we can adjust this based on time, right? We can change the time horizon. If you change the time horizon, the return won't change, but the annualized return will change. So this will change if you change the timing of the investment horizon. So how do we ultimately do these comparisons? We want to compare holding returns, right? We want to look at risk and return. Are you getting the proper return for the amount of risk you're taking? This is a personal question, so we may have some techniques that will give us ideas, but in the end, this is a personal answer that you're going to be looking for to determine whether or not you're getting what you want. So we need, in the end, once you've analyzed returns and you've looked at the risk element, we then have to look at are our investments doing what we want them to do, right? So we need to analyze each investment periodically. We have to ask some serious questions. Has it performed the way you would reasonably expect? And if you didn't currently own it, would you buy it? Right? So a problem investment is one that's has not lived up to your expectations. So you shouldn't necessarily take your losses and leave, right? You really need to take a look, right? What are the chances that this is a temporary downturn, if you will, of expectations? So this question is very difficult to answer. And what we find in behavioral finance, frequently people are reluctant to sell anything that's actually lost money for the thoughts of, well, it will come back someday. So that's the first video on managing returns. So in the next video, we'll discuss a little bit more detail how you calculate performance in returns.